did you? Anything you
Falling stocks depress U.S. dollar against other safe havens. The U.S. dollar fell on Tuesday after Wall Street opened lower, spurring a risk-off move that benefited the safe haven Japanese yen and Swiss franc against the greenback. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all fell more than 2% before recovering heading into the close. The index is dragged down by disappointing earnings from industrial bellwethers Caterpillar Inc. and 3M. The stock market has everyone's attention. The dollar/yen is moving almost tick to tick with stocks, said David Gilmore, partner at FX Analytics. Although the dollar is also considered a safe haven currency, weakness in U.S. markets will nevertheless disadvantage the greenback against other safe havens. The dollar fell against the yen by 0.33%, last trading at 112.43 yen. Against the Swiss franc the dollar was down 8 basis points, last at 0.995 francs. Markets are starting to wonder if the good times generated from Trump's tax cuts and deregulation are in the rearview mirror, and what's ahead is fallout from protectionist policies, and that has started to eat into corporate earnings, said Gilmore. The dollar index, a gauge of its value against 6 major currencies, fell 0.08%. The euro fell after the European Commission rejected Italy's 2019 budget and said it will ask Rome to present a new document within 3 weeks, according to reports from Italian news agency AGI, citing EU sources. The dispute over Italy's spending plans and doubts about the leadership of Britain's Prime Minister, who is mired in a stalemate over Brexit, has investors focusing on the likelihood of further political turmoil in Europe. Worries about Italy's spending have bred some doubt about the European Central Bank's plan to raise interest rates next summer, and that too has hurt the euro. The single currency was down 9 basis points, last at $1.1473. Britain's pound traded up in the European session, before retracing those gains, last at $1.2987, after falling precipitously on Monday over fears that the Northern Ireland border issue and disagreements within Britain's ruling Conservatives over Brexit could cause Prime Minister Theresa May to face a serious leadership challenge. Whispers of a growing number of Tory MP rebels losing their patience with May have put the risks of a lengthy UK political impasse and a Brexit policy mistake, exiting the EU without a deal, back on the table, said Viraj Patel, a currency strategist, adding, "We think this noise is likely to keep the pound on the back foot this week," he said. The dollar is the new VIX and the Bitcoin connection. Over the last few months I have been hammering on the idea that the US dollar is a better gauge of risk in the global financial system, and the so-called fear gauge, the CBOE Volatility Index. When on CNBC I have prefaced most of my equity market commentary with the view that as long the US dollar remains stable then the financial markets should remain calm. But if the US dollar rises, it creates risks to the global economy that are not captured by the VIX index. US dollar's role in the global economy. To understand why this is so, we need to understand the role of the US dollar in the global economy. Since WWII, the dollar has been at the center of the global economy, serving as the reserve currency. Reserve currency status is both a burden and a privilege. It means that most currencies, commodities, and debt are priced in US dollars. It also serves as a reference currency for the majority of global trade. For a country, company, or individual that does not hold US dollars, they must first buy dollars before they can buy the raw materials needed to produce their product. In its latest report on the currency composition of foreign exchange reserves, the IMF reported that over 62% of foreign currency reserves are held in US dollars. The next closest currency is the euro, at a distant 20%. For all the talk of dethroning the dollar, it still remains king. A rising dollar reduces lending to EMs. What this and other IMF data tells us is that the US dollar is used as the base currency in international lending. In order to operate long supply chains, like building IPHONES in China and shipping to the US, companies need working capital. This working capital is financed by global financial institutions and is denominated in US dollars. Herein lies the rub. What the IMF has found is that as the dollar rises, global financial institutions lend less to emerging market economies. This reduction in lending has a negative impact on real investment in the EMs. At this point, some might push back and argue that a weak currency in a net export country is positive for that country's economy, since its goods will be cheaper to foreign buyers. However, the IMF study shows that the diminished credit and the resulting slowing of real investment outweighs the positive effect of a weak local currency. This starts a negative feedback loop. As the US dollar rises or local currency falls, banks curtail lending. This leads to a slower economy, which leads to increased default rates on bank loans. Banks respond by reducing credit, and a deleveraging cycle ensues. US Federal Reserve's impact on the dollar. While the Federal Reserve will tell you that value of the US dollar is the concern of the US Treasury, the Fed's actions have a profound impact on its value. When the Federal Reserve lowered interest rates below zero with quantitative easing, it made borrowing money virtually free. Investors borrowed money at low rates in the United States and then invested in countries with higher interest rates. This fueled the economic expansion of EMS. QE also had the side effect of weakening the US dollar, which, as the IMF has shown, increases lending by banks to EMS. This influx of capital creates a boom. But when that flow reverses, it ushers in the inevitable bust. This is what we are currently seeing in countries like Argentina, Brazil, and Turkey. Repatriation. We have all heard of the trillions of US dollars parked in foreign bank accounts by the like of Apple. The primary reason these profits has not flowed back into the US is because of taxes. Apple and other US companies pay a reduced tax rate on international profits that are kept in foreign banks. But there is another reason. US corporations has been able to borrow money at extraordinarily low rates. At the same time, they lend out the profits at foreign banks at much higher rate of return. This form of financial alchemy is known as a carry trade. But now US corporations have both an economic and political incentive to repatriate dollars. The weak regimes create more risk to lending while the US government has reduced taxes on foreign profits. This accelerates the dollar appreciation and emerging market currency decline. As investors bring those invested dollars home, the local currency falls and credit is curtailed. And the deleveraging bust ensues. The higher the dollar goes, the more risk of a global deleveraging. Said another way, the US dollar is the new VIX. The crypto connection. Bitcoin and other cryptocurrencies were designed to be alternative currencies. The combination of the blockchain and a digital token create a financial system that replicate and automate much of what the traditional financial system has done. Importantly, the cryptocurrency financial system is not impacted by central banks, geopolitical tensions, or capital flows in the traditional financial system. The autonomy of the cryptocurrency-based financial system makes it a viable substitute for currencies financial systems that are in distress due to the stronger dollar. In 2013, when Cyprus had its financial crisis, citizens flocked to Bitcoin. According to Google Trends, interest in Bitcoin has increased in Brazil and Russia over the last few months. To be sure, it is still quite early to declare a meaningful move into cryptocurrencies as imminent. Nonetheless, this developing trend is important to watch. Sri Lanka calls for global coalition to tackle rising dollar. Colombo, Sri Lanka on Tuesday called for a coalition of the willing to help stabilize free-falling emerging market currencies around the globe as the beleaguered rupee slumped to fresh lows. The island's currency bottomed out at a record low 174.12 rupees to the dollar, resisting a slew of measures by policymakers to arrest its steady decline. The rupee has shed more than 12% of its value this year, and Sri Lanka fears it could slide further as U.S. sanctions squeeze Iran, the island's chief source of oil. A stronger dollar has made it difficult for emerging markets to repay debts and battered global currencies from Turkey to India and Argentina. Finance Minister Mangala Samarawira invited those nations experiencing currency crises to visit Colombo and hash out a strategy. The rise of the dollar is having a serious impact on our currencies. We are not the only one affected, he told reporters in the Sri Lankan capital. I want to build a coalition of the willing to deal with this problem. I don't see the global situation improving anytime soon. Washington pulled out of a landmark 2015 nuclear deal with Iran in May, and has been reimposing punishing sanctions on the Islamic Republic, targeting in particular its financial system. Iran not only supplies Sri Lanka with most of its oil, but is one of its chief buyers of the island's celebrated tea. Samaroira has warned that blockading Iran will have ripple-on effects on Sri Lanka, which has been unable to stop the rupee from nosediving. Last month, Colombo curbed its state institutions and public servants from importing cars to reduce the outflow of foreign capital. Banks were also ordered to restrict lending for purchasing overseas and consumer goods, but the rupee has continued its decline. In August, the government substantially increased taxes on small cars to discourage imports, but officials said there was still pressure on foreign exchange reserves to finance big-ticket imports.